Hello guys and welcome back to the MD Investor channel. The channel where regular people talk about personal finance. We talk about setting goals, achieving goals, taking responsibility for our personal finance, and breaking the cycle of generational poverty. We're talking about increasing our financial IQ and the IQ of our children. If this is your first time visiting the channel, welcome. Consider hitting the subscription button and a thumbs up. Leave a thumbs up and let people and friends know about the channel. There's a place to go where we're learning and increasing our financial IQ. So we're back in September. Summer came and went like a flash. Kids are getting ready to go back to school. Whether it's going to be in-person learning, virtual learning, or hybrid of the two, it remains to be seen. But I figured it's a perfect time. What about so kids are going back to school? What about the adult? I think this is a perfect time for the adults to begin to increase their personal financial education. And I figure we will start with stocks. We hear about stocks all the time. The stock market. Stocks are going up, volatility, and so on and so forth. So what are stocks? Stocks are essentially ownership in a company. You can have stocks in a private company, mom and pop laundromat, mom and pop hardware store, mom and pop liquor store, whatever. It's basically equity or ownership shared in a company, right? But of course, in a private company, we don't have access to that, right? But in a publicly traded company, which is what we're going to be talking about, we have access to it. It's a publicly traded company. We have access to it. Anybody can buy a share of McDonald's as long as you have the money, right? Anybody can buy a share of McDonald's. So we're talking about publicly traded company. Stocks are traded on stock exchanges. So stocks are traded on stock exchanges. So the same way we go to a stock market to buy our eggs and bread and milk and cheese and yogurt, in the same way stocks are traded. They're traded on a market. They call them exchanges. So some of the exchanges you might hear is NASDAQ. Starbucks is traded on the NASDAQ. And you have the New York Stock Exchange. Other companies are traded on the New York Stock Exchange. The term you might also hear terms such as Dow Jones, S&P 500, Russell 3000. What are those? Those are basically major indices or major indexes. Essentially, the Dow Jones is basically 30 of the biggest companies in America. And they have them on this list, this index. And it's supposed to kind of represent the market as a whole. Of course, with only 30 companies, that's kind of a small segment, and it's not really accurately, probably, a lot of people say it doesn't accurately represent the entire market. 3M and Apple are on the Dow Jones Industrial. From time to time, companies might come off and new companies might go on, depending on what's going on. S&P 500 is an index, and it represents 500 of the biggest. It has 500 of the biggest companies in America on that index, and that's seen by a lot of people as an accurate representation of the entire overall market. Russell 3000, 3,000 companies, and it's considered an indicator of the entire U.S. stock market, right? So when you hear those terms, don't freak out. They're very simple. You might hear the terms mega cap, mid cap, and small cap. What does that mean? Basically, these are giving you an idea of the size of companies. A mega cap company, like mega, represents large. And in large, in this case, means greater than $10 billion. So a company like Johnson & Johnson, with a market capitalization of over $300 billion, would be considered a mega cap company. A mid cap company, it would be valued between $2 billion and $10 billion. So mid cap, like a medium company, okay? And a small cap company would be a company valued at about $2 billion, okay? $2 billion, so maybe under $2 billion. Those are your startup companies. Small cap company will have a greater growth potential. They're smaller. They might be the small disruptors, new to this segment, disrupting maybe a new services, a new way to do things, and they have a great potential. They also have great potential for growth, but they're also more volatile and maybe great potential to fail as well, right? Because they may not be able to compete with the established companies, but they have great potential for growth. Back in the early 90s, Amazon, which was initially just selling books, right, online, competing against Border Books, which doesn't exist anymore, and Barnes& and Noble, great growth company, right? 25 years later, we see how great the growth potential was. But there was also other companies then back then who never made it, right? So so that's what it is. You might hear the term growth and value. A growth stock, which we kind of alluded to, a company are kind of new and they're doing things in a new way and they're acquiring new customers and doing stuff in a new way and they're growing, right? So the share price is going up at a much faster rate than a value stock, which is more of an established company. They're not growing as fast. You might think of something like maybe McDonald's or something like that, not growing as fast. Everybody already knows them. They already have billions and billions served, and so many restaurants. They're not growing as fast. However, they're established companies. They're still growing, but not as fast. Those value stocks usually attract investors with their dividends because they know that they can't compete with a growth stock like Tesla in terms of growth, but to attract investors, they will give a dividend. So how do you make money in stocks? There are two main ways. One way you make money in stocks would be it's called capital appreciation, and the other way is dividend. Let me give you an example. Say you buy a share of McDonald's, right, for $200, and McDonald's increased in value from $200 to $300. So you have made $100. That's called unrealized gains, meaning until you sell your share, you don't get that money. So it's called paper gains. So you bought it for $200, it went up to $300. If you sell it, that $100 will now come back to your checking account. That's why we said to open a brokerage account, you have to link your checking account. The other way in which you can make money in stocks is by dividends. So you buy a share of McDonald's for $200, and McDonald's is paying $1.25 per quarter, or $1.25 for every 3 months. So $5 a year. So every year, McDonald's will give you $5 for holding that share. That's another way in which you make money. The good thing about companies that pay dividends is they usually increase the dividends year over year. Now, dividends are not guaranteed. The board of directors can at any time say, we're going to suspend the dividend, we're going to cut the dividend because business is not going great, and so on and so forth. But you can get an idea of whether the dividend is sustainable by doing some research. You can see how long have they been paying dividends. It's companies that have been paying dividends for 25 years that they call them dividend aristocrats. Some companies have been paying dividends for over 50 years, like Johnson & Johnson, 3M. They call them dividend kings. So you can look at the dividend history. You can look at certain things like payout ratio to give you an idea. But dividends are not guaranteed. Let's talk about how do we buy stocks? How do we buy stocks? Well, we buy stocks not with a savings account, but with a brokerage account. Okay? So you need a brokerage account in order to buy stocks. There are tons of brokerage accounts out there. And you've probably heard a lot of them, seen commercials for them. Vanguard, Fidelity, E-Trade, TD Ameritrade, Robinhood, some of the new ones, M1. So there's lots of brokerage accounts in there. And to open a brokerage account, you basically go online and you follow the instructions. They ask you some questions, ask you, your personal question, your Social Security number, and the reason why for Social Security number is that so that the IRS knows how much dividend or how much capital gains you made, so they can tax you accordingly. So your Social Security, your name, your address, your checking account, the router number, the account number, basic information. Okay. So that's how you open a brokerage account. And last thing we're going to touch on is taxes. I already did a video on taxes, but essentially, when you make money on stocks, you are taxed. Maybe. So I'm not going to go into a lot of details, but when you work a regular job, you are taxed on your earned income, right? You have the federal tax bracket. You may be in the 10%, 12%, 22%, 35% tax bracket, right? When you make money on stocks, whether it's through capital appreciation or dividends, you're taxed. When you make money through capital appreciation, the way you're taxed in one of two ways. If you have held the stocks for greater than a year, you're taxed at what they call long-term capital gains. So, which is a lower or more advantageous rate than earned income. So, for example, with the McDonald's example, right? You bought the stock for $200, it went up to $300, so you have $100. That $100 will be taxed. If you have held that stock for over a year, you'll be taxed at the long-term capital gains. The long-term capital gains is either 0%, 15, or 20%. So depending on what type of tax bracket you're in, for example, a single person, I think in a 10% tax bracket can make up to like $39,000, and you'll be taxed at 0. Okay? If you've held a stock for less than a year, you'll be taxed. We're talking about now for capital appreciation. If you've held a stock for less than a year, you'll be taxed at the short-term capital gain. Or, correction, less than a year, you'll be taxed at your regular earned income bracket. So whatever your federal income bracket is, if you've owned the stock for less than a year and make money on capital appreciation, they'll tax you as if you had earned income. So it's a more disadvantageous tax bracket. The other way they tax you is if you have a dividend. If you have dividend, they will tax you. And again, dividends are taxed at a long-term capital gains rate. So a quick video guide about stocks. We're getting back to the fundamentals. It is September and it's back to school. Your employer is not going to worry about you learning this. Nobody's going to care about you learning this. You have to care about yourself. You have to take the time to increase your personal financial IQ so you can break the cycle of generational poverty. If there's people out there you think could get value from this, let them know. Send them a link. Give a thumbs up. On YouTube, it's MD Investor. On Instagram, it's MD Investor 1. Remember to command your money to grow, and I will see you on the next video.